IRR. Arr. If you got a $50 return on a $100 investment and it took you 10 years to do it, you wouldn't be all that happy about it. In fact, it'd be pretty disgraceful. IRR, internal rate of return. So what does that mean, IRR, or even the term net IRR, which means, well, let's just look at IRR first. Internal rate of return. Say you make $50 on a $100 investment. You paid $100 for it, you got $150 for it. Your return on investment would be calculated the amount you got from it, the market price, minus the amount you paid for it, $100, divided by the actual amount you paid for it. So 150 minus 100 divided by 100. That would be a 50% return on investment. Normally, ROIs are calculated on an annual basis. So if it took you a year to do that, to get a return on investment of $50 on a $100 investment, a profit of $50 on a $100 investment, that would be a 50% IRR. The IRR is more meaningful because it places a time value of money into the ROI calculation so that people know how to compare the actual achievement or the performance of, say, an investment fund or an investment into a given stock. This all sounds like a lot of financial talk, but I think you know what I'm talking about, because if you got a $50 return on a $100 investment and it took you 10 years to do it, you wouldn't be all that happy about it. In fact, it'd be pretty disgraceful. That you could have made by putting your money in some bond or something. So it's not a high rate of return, internal rate of return. If you did it in half a year, it's actually 100% IRR. And if it took you 5 years to do it, it's non-compounded, it's about a 10% IRR. It's probably about, compounded, it's probably about 8% or so. What you're looking for is the annualized measurement of what your returns are giving you. So if you're a venture capitalist, you like to try to achieve IRRs which are far above like what a bond or a investment in the regular stock market would give you. You're looking for IRRs like, say a decent, respectable IRR would be 15%, net IRR of 15% or higher. In the case of SOSV, we like to do a little higher. We're in the 20s and 30s. But that's also on a net basis. So what's a gross IRR and what's a net IRR? A gross IRR, I'm not even sure we know what an IRR is yet. So let's go over this. You take a basket of investments, say we invested $1 million, and over 3 years it's now worth $3 million. The gain is $2 million over a cost of $1 million. Therefore, it's a 200% return on investment. But the IRR, the internal rate of return, in order to triple your money in 3 years, is roughly 65%, a year. It's actually less because of the compounding. Maybe it's 60% IRR. But say you actually had expenses for doing that as well. That may be a gross IRR that you're hearing. Say you had to fly around the country and pay for going to board meetings and pay people's salaries and pay for other services that you gave to the firms that you invested in, et cetera. So you have to actually, in terms of your net IRR, take out those additional expenses. So the $2 million in gains may have only been $1.5 million in gains, say, at the end of 3 years. So you take that $1.5 million in gains over the $1 million investment, 150% return, and over a 3-year period, that would be roughly in the 40% style net IRR. And that is IRR. VC lingo.